Imagine two friends. Both are 30 years old. Both have $100,000 to invest. The first buys a rental property. The second invests the exact same amount into a low-cost S&P 500 index fund. 30 years later, who ends up richer? Most people already have an answer. Real estate investors will tell you, property is the best investment you'll ever make. Stock investors will say, just buy index funds and let compound interest do the work. But here's the problem. Most people compare these two investments completely wrong. They only compare property prices against stock prices. They ignore rental income. They ignore dividends. They ignore taxes. They ignore maintenance costs. They ignore leverage. And they completely forget about one of the most powerful forces in investing, time. Because over 30 years, small differences become enormous. A return that's just 2% higher per year can mean the difference between retiring comfortably or working another decade. Take Warren Buffett, for example. Despite having access to almost every investment on Earth, Buffett has repeatedly recommended that most people simply invest in a low-cost S&P 500 index fund because, over long periods, very few professional investors consistently outperform it. On the other hand, some of the world's wealthiest people have built fortunes through real estate. Developers like Sam Zell created billions by owning income-producing properties. Countless everyday investors have also become financially independent through rental homes and apartment buildings. So who's actually right? The answer isn't as simple as stocks or real estate, because these investments don't make money in the same way. One grows primarily through business ownership and compound returns. The other builds wealth through property appreciation, rental income, and borrowed money. They're completely different wealth-building machines. So in this video, we're going to compare them using real math, realistic assumptions, and a full 30-year investment timeline. No internet myths, no financial gurus, no get-rich-quick promises. Just one question: if you had to choose only one investment for the next 30 years, which one would actually make you richer? How real estate actually creates wealth. Let's start with real estate. Most people think houses make money because their prices go up. That's only part of the story. Real estate actually creates wealth through 4 different engines working together. The first is property appreciation. Historically, home prices in many markets have increased over long periods, although the pace varies widely by country, city, and economic cycle. Some cities experience rapid growth, while others may remain flat for years. But appreciation alone isn't what has made many real estate investors wealthy. The second engine is rental income. Imagine you own a rental property that generates $2,500 a month in rent. After paying the mortgage, property taxes, insurance, maintenance, and setting aside money for occasional repairs or vacancies, the remaining cash flow becomes income. That income can be saved or used to buy another property. Now the third engine is where real estate becomes unique. Leverage. Suppose you buy a $500,000 property with a 20% down payment. You've invested $100,000 of your own money, while the remaining amount is financed through a mortgage. Now imagine that property increases in value by 10% over time. The property is now worth $550,000. You've gained $50,000 in value, even though you only invested $100,000 of your own capital. That's one reason many investors are attracted to real estate. A mortgage allows you to control a much larger asset than your cash alone could buy. Of course, leverage works both ways. If property prices fall, losses can also be magnified. That's exactly what many homeowners experienced during the 2008 global financial crisis, when declining home values left some borrowers owing more than their homes were worth. So leverage increases both potential rewards and potential risks. Then comes the fourth engine, mortgage paydown. Every monthly payment gradually reduces the loan balance. Over time, your debt becomes smaller while your ownership, your equity, becomes larger. In other words, your tenants may be helping pay down the mortgage through the rent they provide. This is why many long-term real estate investors don't focus only on today's property value. They're building wealth through cash flow, appreciation, debt reduction, and leverage, all at the same time. But before you decide, real estate is the obvious winner. There's another investment that has quietly created enormous wealth for millions of ordinary investors, without fixing a single roof, replacing a broken water heater, or answering a late-night call from a tenant. And that's where index funds enter the picture. How index funds actually create wealth. Now let's look at the other side of the debate. Index funds. Unlike real estate, index funds don't generate wealth from rent or leverage. Instead, they use one of the most powerful financial forces ever discovered: compound growth. Imagine you invest in an S&P 500 index fund. You're not buying shares of just one company. You're buying tiny ownership stakes in hundreds of America's largest publicly traded companies. Companies like Apple, Microsoft, Amazon, Nvidia, Visa, Costco, Johnson & Johnson, and many others. Think about what that means. When Apple sells more iPhones, when Microsoft grows its cloud business, when Amazon expands e-commerce, when Nvidia sells more AI chips, you participate in that growth without running any of those businesses. Now here's where compound growth becomes extraordinary. Let's say your investment earns an average annual return over many years. In the first year, your money grows. In the second year, you're earning returns not only on your original investment, but also on last year's gains. Year after year, those gains begin generating gains of their own. It's like planting a tree. At first, it grows slowly, but after decades, the branches create even more branches. The growth becomes exponential. That's exactly why Warren Buffett has repeatedly recommended that most investors simply buy a low-cost S&P 500 index fund and hold it for the long term. Not because it makes you rich overnight, but because it allows time and compound growth to do most of the work. And unlike owning rental property, there's no leaking roof, no broken plumbing, no property taxes, no tenants calling at midnight because the heating stopped working. Everything is professionally managed by the companies you've invested in. Your only job is to keep investing and avoid selling during market downturns. Of course, index funds aren't risk-free. The stock market has experienced major declines, including the dot-com crash, the 2008 financial crisis, and the sharp sell-off during the early months of the COVID-19 pandemic. But historically, broad market indexes have recovered from those downturns over time and gone on to reach new highs. That's why experienced investors often say, time in the market is usually more important than trying to time the market. So now we have two completely different wealth-building machines. Real estate uses cash flow, appreciation, leverage, and mortgage paydown. Index funds rely on business growth, diversification, dividends, and compound returns. But which one actually creates more wealth over 30 years? Let's put both investments side by side and do the real math. The 30-year comparison, the real math. Now comes the question everyone has been waiting for. Which investment actually creates more wealth over 30 years? Let's compare them using the same starting point. Imagine two investors. Both are 30 years old. Both have $100,000 to invest. Neither adds any extra money after the initial investment. The first investor buys a rental property. The second invests the entire amount into a low-cost S&P 500 index fund. Let's start with the index fund. Historically, the S&P 500 has produced an average annual return of about 10% before inflation over long periods, although actual returns vary from year to year. If that average were maintained for 30 years, a $100,000 investment could grow to well over $1.7 million through compound growth alone. No tenants, no repairs, no property management, just patience. Now let's look at real estate. Suppose the investor buys a $500,000 rental property with a 20% down payment, using the same $100,000 as the deposit. Over the next 30 years, several things happen at once. The property's value may appreciate over time. The mortgage balance gradually falls as it's paid down. Rental income is collected year after year. And if rental prices increase over time, cash flow may improve as well. By the end of those 30 years, the owner could possess a property worth significantly more than its original purchase price, while also having built substantial equity and collected years of rental income. But here's what many YouTube videos leave out. Owning real estate isn't free. Throughout those 30 years, the owner may also face property taxes, insurance, maintenance, vacancies, repairs, renovations, and possibly property management fees. A new roof, a broken HVAC system, water damage, unexpected repairs. These costs reduce the overall return. Meanwhile, the stock investor faces a different challenge. The market doesn't move in a straight line. There will be crashes, bear markets, recessions, and years when the portfolio loses significant value on paper. The difference is, the stock investor doesn't receive phone calls at midnight because a tenant's water heater stopped working. So, does the math prove one investment is always better? Not quite, because the final result depends on something even more important than the investment itself. How you use it. And that's where most people completely misunderstand the real answer. So, after comparing everything, which investment actually wins? The honest answer is, it depends on the investor, not just the investment. If you're someone who wants the simplest possible path to long-term wealth, a low-cost index fund is incredibly difficult to beat. You can start with relatively little money. You're automatically diversified across hundreds of companies. You don't have to find tenants, negotiate repairs, or worry about a leaking roof. Historically, investors who consistently held broad market index funds for decades have benefited from the long-term growth of the U.S. economy, despite market crashes and recessions along the way. But real estate offers something index funds usually can't. Control. A real estate investor can renovate a property, increase rental income, improve occupancy, refinance, or use equity to purchase another property. In other words, you can actively influence your returns. You can't call Apple or Microsoft and ask them to improve next quarter's profits. But you can improve a rental property. That's one reason many entrepreneurs prefer real estate. Then there's leverage. A mortgage allows investors to control a much larger asset than their own cash would otherwise allow. If the property performs well, leverage can significantly increase long-term returns. But remember, leverage also increases risk. If property values decline or rental income disappears, the mortgage payments don't stop. That's why some investors thrive in real estate, while others struggle. Now here's something fascinating. Many of the world's wealthiest investors don't choose one. They own both. Warren Buffett built his fortune primarily through businesses and stocks. Sam Zell became famous through real estate. Yet countless wealthy families diversify across public markets, private businesses, and income-producing property instead of relying on a single asset class. Because the real goal isn't proving one investment is better. The real goal is building wealth that survives for decades. So if you're asking, should I invest in real estate or index funds? Maybe the better question is, which investment matches my skills, my risk tolerance, my available time, and my financial goals? Because the best investment isn't always the one with the highest possible return. It's the one you can stick with for the next 30 years. That's what history has consistently rewarded. Not perfect timing, not chasing trends, but patience, consistency, and letting time do what it has always done best. Turn small investments into extraordinary wealth.